Welcome to America's Commercial Real Estate Show, your source for market intel, forecasts, and success strategies. Hello, I am Michael Bull. The excitement is brought to you by buyproxy.com. Check it out. It's a complimentary service to find properties or list properties, and also you can pay for some marketing. It's buyproxy.com. It's BIPROXI.com. It's a new service. Check it out. Well, today we're going to talk about single-tenant net lease investment properties. You know, the drugstores, the quick service restaurants, the freestanding buildings you see, they're all around the country. And it's interesting to note how these properties are being impacted by rising interest rates. Think about the impact of single-tenant net lease investment properties from people who have had a big rise in values from their multifamily properties or their industrial properties or any multi-tenant properties. A lot of those folks are selling those and 1031 exchanging into these single-tenant net lease properties. But how are they being affected by the government shutdown? How are they being impacted by rising interest rates? How are they being impacted by more the shared economy, the things going on around the world today? Well, let's find out today. Please welcome my guests. First of all, Nancy Miller. She's a CCIM, she's an MBA, and she's a partner with Bull Realty. She leads the single tenant net lease investment group at Bull Realty. Nancy, thanks for being with us.
Thanks, Michael. Glad to be here.
Also, Andrew Ziffer is here with us. He's a managing partner with Greenleaf Triple Net Holdings. Andrew, thanks for being with us, sir.
Thanks for having me, too.
Great. And guys, I'd like to start asking you with this. You're both heavy into this single tenant net lease investment property. What's the market like right now? Kind of the velocity of sales, the kind of opportunities you're finding out there?
Well, I can start on that. The velocity is slightly down from last year. I got a couple stats that might be of interest. Nationwide, we had last year about 1,995 transactions in 2017. 2018, it's down, believe it or not, about 20%. To about a little less than 1,600 transactions. So velocity is down, average price point is about the same. Cap rates are also about the same. We would have thought that they would have started to rise now with interest rate changes, but they really haven't yet.
Well, that's interesting because you'd think it would. So how long are these properties typically on the market on average?
Surprisingly, a property is on the market anywhere between 140 days if it's a smaller $1 to $2 million price range, and up to 195 days if it's a $2 to $6 million type price point.
And that seems to me like it's a long time. Is it because sellers are trying to push that cap rate and push that value as sellers?
I think that's a good piece of it. I think sellers, not to offend any of your listeners, are still kind of wanting to get the top dollar. They're a little bit not greedy, but wanting to push that envelope. And so long as interest rates don't really go up that high, it's possible that they can wait it out and get what they want because they have a fear, if I sell, I'm going to buy in at that low cap rate too, even though I bought in at a higher cap rate.
Yeah, and you want to offend our listeners because they've already got great advice from me. Okay. Buy low, sell high, right? So they already have that advice.
That's great. That's great.
So Andrew, you guys are out there acquiring single-tenant net lease properties. How do you see the market and the cap rates and the opportunities out there today?
Well, for me, every day I'm looking at 100 listings that are coming in my email box. 99 of them are low cap rate, 4 or 5 cap. Some of them are I don't understand some of the business models where these where the Chick-fil-A's and the Starbucks are selling for 4 caps, maybe low 5 caps. I just don't understand it. So number one, these are buyers who are buying stuff with all cash, and you're just putting money away for a little bit and trying to get something better than a bank would give you. So we're not doing that. We actually try to get a better rate of return on our money. So we're looking at the higher cap rate properties with shorter leases, with long-term. We honestly try to find the best of both worlds. We're trying to find high cap rates, quality property, and quality guarantees.
Did you listen to my show, the buy low part? Did I my advice I'd given? You must have heard
A couple
it.
times, yeah.
And a lot of investors in the single tenant net lease world like it because the default rates are really low. They're very safe. And there's not a lot of moving parts, right? Triple net. The tenants are paying the taxes, insurance, the maintenance. It kind of mailbox money sometimes. You mentioned that sometimes to get a better deal, potentially, you're maybe looking at leases with, properties with shorter leases. What are you seeing for a difference on average from your desk of a 14-year lease and maybe a 4-year lease?
Well, we take risks, and so we actually almost had a deal under contract with a 15-year lease at a 7.5 cap, and that was an ideal situation. The seller actually pulled their listing, which was a little unfortunate for that. But all of the deals we're looking at right now are between 5 and 10-year leases. We have learned that all 7.5 cap deals are not the same. Some of them are about to go out of business, and some of them the investor just wants to sell. So we're trying to find the properties at the decent cap rate that have long-term viability at that location with good guarantees, and they're not going out of business next year. So
yeah, that'd be important.
One of our top metrics is sales. So we're looking at sales constantly. We're looking at what the sales are for the location. How does that location sales compare to other location sales and the sales within the brand itself?
Now, some tenants don't report sales. So if you're looking at a property like that and you can't really get the sales, do you stay away from them or what do you do?
I am real good at going to eat lunch at those places and talking to the store manager and trying to get the whisper number out of them. Right. So we have to do our due diligence. We have business partners we go into these properties with. We are doing debt. My name is on the debt a lot of the time, so I want to make sure the property's going to be there for a while. So I'm doing my personal due diligence to make sure that their sales are what I think they are. In fact, a property that doesn't tell us sales or we don't get a whisper number, we usually stay away from.
That makes you nervous, yeah.
Yeah, because we just don't know. In fact,
right.
Yeah, I looked at a restaurant last week, and the manager sat down with me for 20 minutes. Awesome conversation, and he told me his sales, and we decided not to do that deal. But he doesn't, no one told me.
And what are the sales, the rent to revenue ratios, the sales to revenues that you see? Is it you want something under 6, under 10?
Well, the QSR, so fast food restaurants, we're typically targeting about 8%. But it depends on the vertical. So like a Ruth Chris, I've heard Ruth Chris can be up to 5% rent to sales, but some of the larger restaurants like an On the Border might be a little bit higher because it's a larger footprint, and so the rent is always going to be higher because the store is big, and so your rent to sales ratio gets a little bit out of whack, but it still makes sense because it's a big location and the store does well.
And one of the benefits we've had in commercial real estate world is positive leverage. We're getting a higher return on the properties we're buying if we pay cash in our cap rate than the financing. So Nancy, what are you seeing today? Are we still getting positive leverage on some of these single tenant net lease properties? What are interest rates on single tenant? How do lenders look at these today?
Well, the typical net lease investor is going to do a 65% LTV, 35% down, using that as a 25-year amortization. I have a couple stats I just got from one of my handy folks here, and what's interesting is while rates have crept up, 17 they were about 4.25 to 4.5, 18 4.75 to 5. They've just come back down, and they're averaging right now somewhere between 4.6 to 4.85, depending on the quality of the tenant, depending on the remaining lease term, depending on if that lender hasn't taken on too many of that tenant brand. Sometimes if they have a lot of dollar stores, they don't want any more dollar stores and so forth. But I think as my crystal ball, yours and Andrew's, we don't know what the feds are going to be doing over time, but right now is a very good time for people to get their toe back in the water to work on the spread between a cap rate and an interest rate with 65% down, they'll have some positive leverage.
Yeah, I think it's a good point. Whether it's single tenant or any property you're looking at buying or selling right now, we've had a reduction in the Treasury bill. We've got reduction in interest rates now, kind of a window, because the Atlanta Fed has mentioned they are going to do at least a one rate increase next year, or indicating that they probably will. So it is a nice window right now, isn't it?
It is.
Yeah.
It is.
So what are you seeing from, Andrew, when you're out there looking at properties today? What kind of categories or tenants are maybe you're nervous about? What categories and tenants do you kind of feel comfortable with?
Well, first of all, to kind of go back to one of your points, we actually financed two of the same properties in 2017 and 2018. We financed one for mid-4s, and literally the same property the next year was 5.5. So
Wow.
interest rates are in just a year have went up a whole point. And that's a pretty big deal.
Yeah.
So our box at Greenleaf, we tried to make our box pretty small. We started out with any sort of triple net deal, auto parts, restaurant categories, banks. We looked at even at a couple of Planet Fitness, but we narrowed our box into the food category. So we're doing QSR, quick service restaurants, fast casual, and casual dining. So anything that you eat at, maybe a step below a Ruth Chris, we will look at right now. And we're looking at fundamentals of real estate. We're looking at good locations, so a property that doesn't have a reuse capability, we don't look at. We look at quality guarantees, and the quality guarantee doesn't necessarily have to be somebody who owns and operates 200 or 300 restaurants. It has to be somebody who has been there for a long time, has a viable business. One of my most successful deals right now is an operator of approximately 5 units of a fast food restaurant, and he's a great tenant.
All right, well, good. Well, I'll tell you, we're going to take a short break. When we get back, I want to ask you guys some tips for maybe some ways to get some higher returns and some mistakes to avoid. So stay with us. I'm Michael Bull. This is America's Commercial Real Estate Show.